Hello everybody, this is Lara with your end of the week video for US oil for the trading week ending Friday 16th of July 2021. The main Elliott Wave count still expects upward movement to resume. The next target is at 110.61 to 112.79. For a long time now I've expected oil has found a major sustainable low in April 2020 and is in a new bull market, and that's what's been happening. At the monthly chart level, this Elliott Wave count for oil expects a counter trend movement ended down here as a super cycle degree second wave, and when a second wave ends, a third wave follows. Super cycle wave 3 may only subdivide as an impulse. At cycle degree, it'll be labelled 1, 2, 3, 4, 5. Within cycle 1, it too is subdividing as an impulse at primary degree, 1, 2, 3, 4, 5. This big channel is important, and importantly prices made new highs above this prior major high, giving more confidence that oil is in a bull market. This channel has been breached. If we see any surprise deeper corrections at this stage, I would expect a back test to find support at the upper edge of this channel. Let's take a look now at the weekly chart, where this slowdown here is this point down here, the start of this bull market for oil. I'm labelling it so far as primary 1 and 2 and primary 3 incomplete. A target for primary 3 is for it to reach 2.618, the length of primary 1, at 121.43. Within primary 3, it may only subdivide as an impulse. I'm labelling intermediate waves 1 and 2 complete here and intermediate 3 incomplete. The target for intermediate 3 is for it to reach 1.618, the length of intermediate 1, at 112.79, and this is why I have the target of 2.618 for primary wave 3, so that these targets fit together. Draw a channel around this upward movement from the end of intermediate 1 to the last high for oil. Pull a parallel copy down on the end of intermediate 2. Keep redrawing the channel as price moves higher. This channel, when intermediate 3 is complete, would then be an Elliott channel, drawn using Elliott's first technique, and then the lower edge could be used to indicate where intermediate 4 may find support. Within intermediate wave 3, no second wave correction may move beyond its start below 57.26. Let's take a look at the daily chart level now, where this high for minor 1 is this point here. Here's the end of intermediate 2 and the start of intermediate 3, which may only subdivide as an impulse. I've changed the labelling here slightly, and I've moved this up 1 degree to see minor waves 1, 2, 3 and 4 within intermediate 3 complete. Minor 3 is longer than minor wave 1. It has a 1.618 Fibonacci ratio to minor wave 1. It's very close. Minor wave 4 may be over here, finding support at the lower edge of the Elliott channel. If it does continue lower or sideways, it may not move into minor wave 1 price territory below 66.75. Minor wave 1 is labelled as a leading contracting diagonal, minor wave 2 an expanded flat, minor 3 an impulse, and minor 4 a zigzag. So there's perfect alternation between the flat of minor 2 and the zigzag of minor 4. The Elliott channel is drawn from 1 to 3 with a copy on 2, and minor 4 may have ended its support at the lower edge. It could also continue sideways as a triangle, and it would remain within the channel and still have alternation with the flat of minor 2. The target for intermediate 3 is the same, 112.79. Alternately, at the daily chart level, it's all the same to this point here, but it's possible to see intermediate wave 3 over at the last high for oil. What if we see downward movement again next week? What would that look like? This wave count is judged to have a lower probability because here, if intermediate 3 is over at the last high for oil, then it's 14.61 shorter than the length of intermediate wave 1. This market has a strong tendency to see its third waves extended, and so with a third wave here shorter than the first, that has to be judged to have a lower probability because it's not a common occurrence. If intermediate 4 does continue lower, I'd expect it to find support at the lower edge of this channel. This channel is drawn from the high of intermediate 1, which is off to the left of the chart, and you can see where that is on my weekly chart, to this high here labelled intermediate 3, and then a parallel copy is placed on the low of intermediate 2, and it beautifully shows where these pullbacks have found support. And so if we do see a surprise deeper pullback right here for oil, then I would expect the lower edge of this channel to again provide strong support. If this wave count does turn out to be correct, then intermediate 5 will be limited to no longer than equality in length with intermediate 3 at 19.71 in length. Classic technical analysis now for oil. How much support is there for either of those wave counts? Are we going to get more downward movement? At the weekly chart level, we have a bearish candlestick reversal pattern, but the third candlestick doesn't have push from volume. It doesn't need it. It's impressive to see when it does, and you can have more confidence when it does, but this is a bearish candlestick reversal pattern. There was another one here, and it was only followed by a little bit more downward movement. And this is a nice illustration of one of the problems with candlestick patterns. They make no comment on the direction of the next trend, and they make no comment on how long that trend will last. They're not always or necessarily a full 180-degree reversal, because there are 3 directions for price: up, down, or sideways. And a candlestick reversal pattern tells you price is changing direction, but it doesn't tell you if it's the opposite direction or sideways, and it doesn't tell you how long the new direction may last. To look at that, we need to look at other indicators. So what do they say? ADX is extreme. It's above both DX lines, but it's not very extreme. It's not yet above 45. This market can sustain very extreme trends for quite a while, so there's further room for the upward trend to go before conditions become very extreme. RSI was overbought, it's back in neutral. There was bearish divergence, but it's relatively weak. It's not clear and strong, and if it's the stronger the divergence, then the more likely a deeper pullback. Weaker divergence generally would be expected to lead to a weaker pullback, and so the pullback could actually be over here, and that would support the main Elliott wave count. At the daily chart level, how much support is there for either of those wave counts? Here at the high for oil, we've got a bearish engulfing candlestick pattern with a long bearish upper wick. That bearishness could now be resolved by some following downward movement, maybe finding support close to the 55-day moving average. I use a 55-day average because it's a Fibonacci number. It's close enough to 50. Friday's candlestick has a small real body and, importantly, a bullish long lower wick. And although price moved lower and it closed green, it is a downward session, and volume is not pushing price lower. Price is falling of its own weight. That's a shorthand way of saying price can fall due to a lack of activity from buyers just as easily as it can due to activity from sellers. So price can fall on light and declining volume, and it can fall hard and quite fast. ADX is declining. There's no clear trend, but if it turns up, then there would be a downward trend indicated at the daily chart level. ATR is increasing as price, and then it flattens off now as price moves lower. So volume is declining and ATR is essentially flattening off as price is moving lower. So there's not necessarily a lot of strength in this downward movement, suggesting that it may be more of a short-term pullback in nature at this stage with the data in hand. On balance, volume giving us no signals this week. RSI in neutral territory, plenty of room for price to fall or rise. Stochastics also neutral, and MACD bearish. That's all from me this week with your oil analysis. I hope all of our members are having an awesome weekend.